Good evening, everyone, and welcome to Admiral Markets webinar of 17th of July 2014. Today, Chris is with me, and we are going to talk about trading decisions. So we will share some of our advices. We will talk about good and bad decisions, and of course, after me, Chris will speak, and he will ask you a few questions. He basically made a quiz. So I invite you all to join and answer a couple of questions, which will be presented to you after Chris' presentation, during the Chris presentation. Before I begin, as always, standard is disclaimer, and then we can proceed further. Online educational materials are developed by Admiral Markets AS Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Risk disclosure statement stating all the possible risks associated with Forex market. By accepting the risk, you are also proceeding further with us. And Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the authors, me and Chris, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not the .co.uk website, but the globallyused.com website. Forex is risky business, and this is a personal opinion only. This webinar is for informational and educational purposes only. So, with having said that, I will show you a couple advices. We'll tell you what trading decisions you should avoid, then what are good trading decisions, even though if you make a mistake, it can be a good trading decision. It doesn't matter. And summary of that all. So trading decisions should be made always after the careful analysis of the market. I can say most of the new Forex traders just don't take the time to learn what exactly drives currency rates. Usually fundamentals and news are giving a necessary momentum to Forex market. When news or a statement is due, usually some traders close their position and wait for new opportunities. That is correct way to do. But usually those traders do not enter after retracement is happening, and basically they can miss the whole move up or down. So that is why I'm always saying, if you spot a good entry price after the news, you can go within a trend direction. If the news is moving the price by a huge volume, a momentum, then do not trade it. So we always need some good fundamentals to give a proper boost to market. If there is no any fundamental decisions during the day, usually the price will range, and usually there will be some random noise that will follow, that will precede a fundamental price move. Also, when you make a decision, you should never regret about doing so. Your decision can either be good or bad. If you made a trading decision, do not regret it. Even some good trading decisions may not come out in profit, but you know that you did a good thing because you had your stop loss and your risk is very small. The worst thing you can do is panic and be very nervous about decisions or the decision you made. Never ever panic. Why would you panic? Why would you sweat? If you put a stop loss, if you know where your stop is, why would you panic? If you're risking 0.1, 0.2, 0.5 per trade, why would you panic? Don't do that. Usually those panic traders and nervous traders are those who don't use stop losses and who use a whole lot leverage than they should. Making decisions in trading is basically the everyday process. Also, decisions which we made during our life are also considered everyday process. So It's the same for trading. When you do it, you just stop thinking about it and let it go. Never ever blame the outside factor for bad trading decision. So if you blame your friend because he gave you or she gave you a wrong order, why would you blame him or her? Blame yourself because you have made a decision just by using outside factors. I'm not saying that you shouldn't listen to proven and profitable traders, but eventually, if you want to trade, you should always follow your method and base your decisions on good and proven factors. So never ever blame the outside factor for a bad trading decision. Which are bad trading decisions? I think that the primary mistake and very bad decisions are usually made and classified as newbie decisions. When price is going up, the worst you can do is buy here, close to resistance. Or if the price is going down, sell here. Even though if you shorted it there and the price have gone here and spiked your stop loss, you still made a good decision because you sold the price when it was high. Worse decisions are usually made when the price is breaking through resistance and going through support. Usually when that happens, you will be on a losing side because the price may move a couple of pips to the upside or a couple of pips to the downside, doesn't matter, and you will lose your entry. You will lose your trade. Also, the thing which I need to mention is entering the trade with inadequate leverage. If you're basically trading with too high of a leverage, that is considered very often also emotional trading. If you don't do your pre-plan and usually your trades are based on emotions. Thoughts about particular trade are also emotions and a very poor basis for doing trades. So just ask yourself, do people say intelligent things when they are upset and emotional? Usually it's not like that. Usually when people are upset and emotional, they're not saying intelligent things. And also many times you will enter with inadequate leverage, risking 3, 4, 5% per trade just because you were very emotional and you were overconfident. Also trading very low volatile market. I already showed you how you can trade low volatility, but don't always do that. When there are no big fundamental things pre-NFP, it's okay. But if banks are on holiday, then if you're still very desperate to take a trade, take one trade. Don't trade it. Don't make any reverse orders. If you lose a trade, okay, you're done for the day. So trading needs volatility. So low volatile market, as you know, can be traded, but try to trade it as low as possible. Also relying purely on others. Others may think fine. You also can find many other traders, many other analysts pretty good. But it's okay if you follow me, follow Chris. You will usually learn something good and make probably a good trade. But don't just rely purely on others. If you like how they trade or how those others which you are following trade, then try to learn how they trade. Try to master the method and try to participate in discussions. That is always a good thing to do. No trading plan before making a decision. That is also a bad thing. Everyone wants to make money from trading, but that is not a trading plan. Trading plan is your blueprint. It's a blueprint for trading success. It gives you basically a shape it gives you your edge. If you don't have an edge, you don't have a plan, and likely you will be part of 95% of traders which are losing. Also, trading a currency, not a pair. If you want to trade currency pairs, then basically you are trading a Forex market. But so being right about a currency is usually half a trade. So success or failure depends upon being right also about the second currency that makes up that pair. Also, lack of confidence. The lack of confidence can be very, very disturbing. If you are not confident in your trade, if you lose money early in your trading career, I know that it's very difficult to gain true confidence. So the trick is to learn the business, invest in yourself before you trade. So you need to learn about yourself, you need to learn about a system, you need to learn how it works, how market is flowing before a single decision is being made. And that usually, and I'm usually referring to basically start of a trading career. So I know that 98% of traders lose money early in their careers. But that shouldn't be the case if you have the plan and if you know where to invest to. Also, too much indicators in a system is also a very bad thing, because if your indicators are if your system is stuffed with many indicators, that is not how money can be made. Do you really think that price follows all of those indicators? No, the indicators follow the price. And yes, big banks do not trade by using 10 indicators. When we talk about trading, and when we talk generally about making a good system, you just need a couple of indicators to tell you where to go. I just hate when I see so many systems which have I don't know, 6, 7, 8 indicators, and they say it's for a filter. What filter? Do I use filter? I only use MACD and Camarilla levels along with price action. Okay, when you scalp, you can use moving averages. You can use MACD. Why would you use RSI, CCI, MACD, and 10 different indicators in a system? That's nonsense, believe me. Too much detail. You shouldn't ever be paralyzed by analysis. It's called paralysis by analysis. So don't give too much details to your trading decisions. Why would I go long here? Why would I go short here? Too many indicators. Guys, a setup and a trigger is all you need. Wait for the price to touch the level. Wait for your confirmation of your system and entry. And if you believe in your system, get in. Jumping on a Fri Train. Usually traders, what most of traders do, when price is moving up, they enter there and they are basically jumping on a Fri Train. It can be that the price will move this way, but usually what I do is wait for retracement, then go in a trade. If I don't get the retracement, why? It doesn't matter. If we trade more than 10 pairs, we will always get 1 or 2 trades, 3, 4 trades per day. So don't jump on a Fri Train. Wait for proper setup and then go in. So you shouldn't ignore technical conditions. So determining whether the market is overextending long or overextending short is a key determinant of near-term price action. Spike moves usually occur when the market is all one way. So as I say, trend is your friend. I can say relying on MA crossovers Relying on MA crossovers will get you usually too late on the trade, and relying on MA crossovers will kill your account if you do it when market is ranging. You know what crossovers are, and they can work on a trending market. But when market is ranging, you will get multiple of false signals, and you cannot filter it with any indicator. So relying on MA crossovers is a stupid thing, guys. I just don't recommend that. Being too confident in your trade will get you to other level, which probably will get you to being over emotional. And we talk about spiral of doom, you remember. So usually overconfidence will get you in also making over leveraged trades. So don't be overconfident. You always need to risk how much basically you're willing to lose. You shouldn't ever over rely on the risk reward. So guys, that is how I do. I usually make those things big risk rewards, but because I'm usually using a trailing stop, most of the time my trades are positive, and I am a profitable trader. And I can, whoever is interested to learn those CAM MACD which we are trading, basically I always show my real account statement. I don't have anything to hide. There is zero advantage, guys, in today's market in risk to reward. If you put 20, 30 point stop and 60 points profit, and you always go for 2 to 1, 2 to 1 to 3, your chances are that you will lose. Good traders and profitable traders always think about risk reward in relation to their personal assessment of what they see as their probability of the trade being successful. So when I make my stop loss, I always base my overall risk in that stop loss. It's same for me if I use a 15 pip stop or 30 pip stop. The risk is always the same, 0.5%, 0.3, sometimes a little bit more, sometimes a little bit less, but it's a small risk. And if you always go for a big risk to reward, chances are you will lose. Because market today will not move as it moved 10 years ago. That was the common story 10 years ago. Then you should only make a good, you should only have a good system and make risk to reward 2-1, 3-1. Yes, but it doesn't work in today's markets. That is why you should always trail your stop and protect your profits. Put your stop loss to break even after 15 pips. Put your stop loss to 20 after 25 pips have been made. And stop being overconfident. Don't trade for the wrong reason. If euro dollar is going down, it's not just enough reason to short it when it comes to support. Even if you lose the trade, you made a good decision if you bought it of important support. It doesn't matter. Maybe the trade will fail, but ultimately it's a good decision. Buying of support is ultimate good decision. It never cannot be a bad decision. Even if you lose the trade, it was a proper decision. If all other factors are also in play, I don't know, divergence or MACD cross or whatever. Also, stochastics. I need to say about stochastics. Stochastics can be very useful on scalping systems. And I personally teach how to use stochastics in scalping methods. They are good. But the thing is, you cannot rely on stochastics on high time frames. If it's overbought, it can stay overbought for a couple of days. If it's oversold, it can stay oversold for a couple of days. So if you try to buy on the first sign of overbought and selling on the first sign of oversold, Well, what, I don't know. Usually it will end up wrong. But trading on lower time frames, it's okay. Ignoring strong news. Trading during FOMC Fed minutes bid rate conferences. Guys, usually what can happen is you are in a profit. And you are in the profit, but your stop loss is still at the same place you originally entered. Basically, I don't know, let's say that euro dollar is going down. And now we have, let's say, another bid rate conference, or Draghi speaking, or I don't know, FOMC or Fed minutes. And what can happen is price can kill your stop loss and then proceed down. So always do not ignore strong news, and never ever trade during huge volatility. If you want to exploit high volatility, you know how to do it. I showed you. Wait for the candle close, big volatility candle, then enter on retracement. Do not trade the move itself, because who knows what can happen when an important person starts speaking. We are not prophets. We don't have crystal ball. If we had crystal ball, we probably wouldn't trade each day. We would make one entry now and we would wait 10 years, and after 10 years we would be millionaires. So don't guess. Also, compounding on bad trades. Those are all, guys, bad trading decisions. Bad trade decisions. Compounding on bad trades. If you lose, then put your stop loss. Don't ever enter another position on a losing position. Let's say that initially you want to go long of this level. So basically what can happen, the price is here, your stop loss is there, and you enter long. Now, if you made a proper risk potential and proper risk size entry, you can add one position here, you can add second position here, as long as your risk is kept under control. Now, if the price spikes, stop loss, okay, you're stopped out, but usually that is within the borders of a risk. But what if you don't have a stop loss and you're just adding to losers? That's stupid, and never ever do that, guys. Never ever. Adding to losing positions is not recommended, because you're compounding basically on bad trades. Don't move your stop loss. Your stop loss should always be the same. Take a loss, place your stop beforehand, and never increase your predetermined risk. If it's going bad, it's going bad, but it could get even a lot worse. So your risk is here. Do not widen your risk. That is basically what many traders do. Many traders do. Yeah, a quick question. Can I repeat Fri Train? Yes, Fri Train is jumping on a Fri Train. If you see that the price is moving up, do not jump here, because usually you will jump in big resistance, and price may get a few pips to the upside and then proceed into retracement. So never ever jump on a Fri Train. Try to call, guys, if you see the price is moving up, the chances it will reverse, giving you proper next swing. So even though if you lose this trade, you made the right decision because you didn't jump in on Fri Train. Try, guys, not to do that, because if you do that, ultimately you would lose. Okay? What are good trading decisions? I will speak on my behalf what I think that what good trading decisions are. So first of all, knowing what trend trades are, waiting for retracement, spotting chart patterns, waiting for confluence, buying low, selling high. Trend is your friend. That is trend trading. And 90% of the time, guys, we would be doing those trend trades. You know that already. So usually our trend trades would be successful. Now, if you wait for retracement, that is okay, because you will be trading within the trend. Because the trend is not this. Trend is this. This is trend. Trust, pull back. Trust, pull back. That is trend. You should know what trend is. So if you want to take a trend trade, you should wait for retracement, spot chart pattern, wait for a confluence, buy low, sell high. Trend is your friend. What are breakout trades? Breakout trades are not buying on daily highs and selling on daily lows. Waiting for a breakout retest after pattern confirmation. Waiting for a breakout pullback continuation after triangle pattern pivot confirmation. Not making too many trigger happy trades. Trigger happy trades can be exciting. Let's see, you want to trade a triangle and bang, it broke. Okay, you enter at the first break. But usually, sometimes those trades can reverse, spiking your stop loss. If you treat trigger happy trade as basically as a scalp, yeah, it's okay. It can be good. But if you don't treat it as a scalp and you leave it for too long, the chances you will lose the trade. Scalping, what scalping is? If you know what scalping is, then good. If you don't know how to scalp and how to make those decisions, then don't do it. Don't scalp it, guys. It's simple as that. It's very simple. Do not scalp if you don't know what scalping is. Okay? Too many indicators. We don't want to see too many indicators. I already talked about it. We don't want to see too many indicators. We want to see proven track record of a scalping system. Lowering your stops and targets. Okay, if you scalp, your stops should be lower than intraday trades, but also your targets should be lower. And it's hard to go with 1, 2, 1, 3 if you don't know how to switch from a scalp to scalp swing or scalp swing to intraday position. Okay? Proper money management also. What proper money management is? Do you know what proper money management is? Try to think about it. If you scalp, okay, but also do not raise your leverage by a huge percent just because your stop is a bit lower. What is counter trade? When to counter the trend? Which are important support resistance level? When to counter trade? Is the proper timing now to counter the trend? Those are all decisions you should be making before ultimately going on a counter trend trade. And counter trend setups are just they're harder than trend setups. That's normal. That's normal, guys. Because trend setups are friendly. Counter trend setups can be unfriendly. Yeah, you usually will enter the earliest entry possible. But if you don't know what counter trend is, then just do not go blindly into a trade just because there is a strong level which is touched. You need to know the proper rules for counter trend trading. This is the example of a good trading decision. Why? Because we have a high here. We see that the price has been rejected multiple times at this level. We also have an inner trend line which basically is touched after the retracement. So let's see this example. It's a perfect example of a good trade. The trend is down. It's clear that the trend is down. This trend line has been broken and this is the first swing. This is Fibonacci retracement, 50%. Now, if we draw a trend line, we see a retest of this trend line. Retest is happening very close to previous selling zone. which is very, very strong. So making trade here at 50% at the touch of this line, close to this high, is a perfect entry. This is really, and you always need to know, you always need to analyze the market, but not overanalyze. And in this example, you sold it high, so basically it's a great trade, and you see how the price is doing. This is inner trend line. Trend line, when it's broken, once it's broken, it becomes an inner trend line. This is an example of a good head and shoulders trade. Trading here of the right shoulder is also good. Trading here after the retest of a neckline is also good. Trading here at the break of previous important support is also good. So this is, now pay attention, I will also repeat this. This is breakout. This is a retest. So if you make your entry here, it's called a retest, and it's a proper retest because the price has broke through important support, but it retested the support. So the chances are it will proceed down. If you're trading of this level, it's called breakout pullback continuation trade, because this is breakout point, this is pullback point, and at this point, this is considered to be continuation trade. So those are all good trading decisions. It's also good. So if you spot these, if you trade like this, making logical decisions, you will be safe. Ultimately, you will be safe. Triangle breakouts. Now, triangle breakouts. Trigger happy trade. Trigger happy trade means entering immediately after the breakout of this triangle. This is breakout retest trade because the breakout happened, retest came here. This is breakout pullback, and from this point continuation trade. So all of those decisions can be good decisions ultimately, but one factor is important. You need to know about those decisions, all of those before mentioned factors, and when to trade and when not to trade. So after above mentioned logical trading decisions, we also need to add the approach. Before you start to trade, recognize the value of proper preparation. The first step is to align your personal goals and your temperament with the market which you are comfortable. So if you know the system, then you will analyze the time frame. The time frame will indicate the type of trading that is appropriate for your temperament. If you trade off a 5-minute chart, that means that you are, I can say, more of a scalper. If you are trading 1 hour, that means that you are intraday trade. If you want to trade also 1 hour, that can also mean you want to take advantage of breakout. You need to know which market you are trading. So it's not the same whether you're trading stock market and forex market. If you are a forex trader, then you need to know the system which can be traded for each currency pair. If you don't have the system or method which can trade every single pair, then you're probably stuck with trading 1 or 2 currency pairs. Then we have a patience. Once you know what to expect from your system, you need to have the patience to wait for the price to reach the levels that your system indicates for the point of entry or exit. If your system indicates an entry at a certain level, but the market never reaches it, which happened to me, if you remember my analysis of New Zealand yen went to my target, but it didn't reach the price for my entry. Then you should move to next opportunity. That is the beauty of multiple currency pair trading. There will always be another trade. Don't chase the bus after it has left the terminal. Wait for the next bus. Discipline also. What is the discipline? The discipline is the ability to be patient, to sit tight until your system triggers an action point. As I said, sometimes the price action won't reach your anticipated price point. At that time, you must have the discipline to believe in your system and not to second guess it. Discipline is also the ability to pull the trigger when your system indicates to do so. That is especially true for stop losses. Objectivity. Objectivity depends on the reliability of your system or methodology. So your system should be reliable enough so you can be confident if you're acting on its signals or its entry positions. So this is all what I wanted to say to you. Now Chris will continue. So eventually, guys, think about these things which I explained, because you need to answer whether you're making bad decisions or good decisions, but you don't need to tell us at this moment. Try to think deeply in yourself and try to come to the senses whether you will be continuing to try on based on bad decisions, or some things you will change, but change for the better, just to be able to trade on good decisions. So Chris, you can continue and we will talk a little bit more.
Great stuff, Nana. Thank you so much. Very useful indeed. Making good trading decisions. I loved all of these pointers, in fact, and very good introduction or explanation, I should say, better word, for what we want to avoid and what we want to look for. In my part, I actually want to take the knowledge that you have now learned from Tarantula and make a small little quiz, if you like. So this will be requiring your active participation. I hope I didn't make the questions too complicated and too boring, but it's a bit actually more difficult than I thought to make a quiz. Still, I hope you will enjoy it. So get close to the keyboard, get your pen, or no, actually, yeah, you can take a pen, but better probably to put your fingers on the letters, because it will be a multiple choice in most cases, so you can then participate. I'll count all the answers and see which answer gets the most votes, and we'll consider that one to be the group vote in a way, so we can see if the group majority is choosing what I consider the right answer. So time will tell, but don't stress too much about it. It's just for fun. So let's see how actively you can use and fast you can use the knowledge you got from the first part with Nanette in this webinar. Alrighty, so I can skip the first thing here and go right away to this screenshot. Okay, take a look. In the meantime, I'm going to say some things about the screenshot. No. This one. So take a look. What you see here, well, the pair doesn't even matter. I don't remember, it doesn't say, but we obviously see price above the Tenkin and Kiyun and an EMA. It's a 50 EMA close. So the Tenkin is green, the Kiyun is purple, and the 50 EMA is maroon. To be very precise, we have a stochastics at the bottom and obviously a blue, bullish, red, bearish candlesticks. That's it. So it's that simple. This trader is, wait, I actually, hang on. Sorry about that. I actually have the wrong document. I have here a text that I want to read prepared, but I actually have the wrong one open. Oops. Wrong preparation here. But I already found it. Good. Trader CJ wants all of these three to be aligned for trending environment is present. So as you can see, this is a trending environment here. CJ uses tops and bottoms as a filter, and the stochastics if it's oversold, or if price is too close to the support or resistance, the trade will be skipped. So not very important, by the way. It's not, that we'll see it in this. So I'll skip this. The opportunity is for the trader is when price is at the Kiyun, the purple one. When price gets back to the Kiyun or the 50 EMA within an uptrend, that's an opportunity. So basically, what you're looking for here is when all three are aligned, but price gets back to the purple or maroon. So this was an opportunity here where I have a green. Let me show you. This was a green dot opportunity here, and here, and here, and here. And these are all opportunities, all right? When price is all aligned and they get back to. So those are all previous opportunities at those green dots, okay? Excuse me. The trigger is when when candlestick patterns appear near the opportunity levels. Candlestick patterns appear near the opportunity level, all right? The entry is a candle close of the candlestick pattern. Candle close is simple, actually. Let's take a look at the first question. Considering the fact that there is no weekly resistance close by, do the candles with the orange arrow and or black arrow translate into long triggers? A, none of them. Yes, orange for B. Yes, black for C. Or D, yes, both of them. So let's take a look again. This is the orange one, the orange arrow, that candlestick we're talking about, and the second black arrow is the second one. All right. So once again, all three have to be aligned. Yes, they are. Price has to go back to basically to the moving averages, and we want a candlestick pattern. We want a reversal potential here at those moving averages. So do these two candles basically have that particular event? So that's the trading plan. Do you see both of them having it, or only one, or none of them? So now it's your turn, in fact, to answer that question. I hope it's doable. You can write either the color, or you can say indeed one of the letters. A, once again, is none of them. B is yes, orange. C is yes, black. D is yes, both of them. So A is none, D is both, B is orange, C is black. So it's a trading plan test. Thank you so much. I got good number of answers here. Let's see, 2, 4, 6, 8 of them already. Great stuff. And I'll give you, let's say, 20 more seconds, and we can move on to the second one. 10 seconds left. Anyone else? Maria is asking what's the media line brown? The media line brown is a 50 EMA close. 50 EMA close. So folks, that wraps it up. 8 answers. So great. We have 2, 4, 6 C's, 6 times a C, 1 A, and 1 D. So clearly majority chooses C, and the correct answer is C, indeed. So the group got the right answer there. For those that didn't get the good answer, don't be mad. That can happen. And the reason for that answer C is because the opportunity is when price hits the purple or the maroon as a retracement. So in the orange example, price didn't get back to that level yet. After that, we're looking also for a candlestick pattern, which the bullish reversal candle is showing. That's why C is a trigger, is indeed a potential setup there, but not the first one because it didn't retrace deep enough. Yeah, orange is indeed a continuation of that retracement to the downside. Or I'm not sure if that's what you mean, but now don't get me wrong, this is not something I trade. It's just a quiz question, that's all. I just was looking for something that to ask you basically. From a different angle, something different, so that it's neutral. not something that anyone has an advantage necessarily because they look at my webinars on, or something like that, you know. So Capitanu, there's the 50 you may close. I wrote it down there. Okay. So next one. Let's see. I'm not sure if we're going to get to all these questions, but that's okay. Trader CJ takes the trade upon the retracement to the 50 fib. It's difficult to see it because it's so small. Sorry about that. But right in the right corner, you have a very small fib. This basically, this pin bar here, this bullish candle was the trigger, and he takes the entry at the 50 fib. So he put the fib on that daily candle, that one daily candle. Okay. So the trader CJ puts the fib on that daily candle, takes the 50% level, and places the stop loss below the candle low at that red horizontal line, and takes the entry at the green horizontal line. Half of the trade is exited upon the daily candle close below the Tenkin, whereas the other half is exited upon the cross of Tenkin. So let me repeat that. Half of the trade is exited, only half, upon the daily candle close below the Tenkin. So it's assuming that it crosses the Tenkin, maybe, okay, doesn't matter. And the other half is exited upon the cross of Tenkin below the Kiyun. So it's a Tenkin Kiyun cross. The trade moves favorably, right? Goes our way, and a second trade is initiated. Let's see. The second trade is initiated upon here, the closure of this candle above the Tenkin. Alrighty. So there's a second entry. I think there was a mistake here, but somehow. But anyhow, let's see. So what do you think of this setup, basically? All right. We have a first entry here at the 50 fib and a potential second entry according to the trading plan. Or well, that's the question. Is it? But in any case, it's a bullish candle that closes above the moving averages. That was that's a trigger in a way according to the trading plan, right? It closes above all these, so it's moving back into the direction of the trend. What are good things and bad things about this setup? The second one, basically, I'm talking about. All right, the first one is going in the direction of this trader. The first thing, A, trader CJ takes an entry because candle closes near the candle high, which we can see indeed. Look, the candle closes near the high. Anyhow, the previous trade is up 200 pips, so that's good. Or is it B, trader CJ takes an entry because candle closes near the candle high, which is good, and has engulfing twins as well. Engulfing twins, is that a good thing or not? Trader CJ takes an entry because candle closes near candle high and Tenkin is pointed in opposite direction. Is that a good thing that the Tenkin is pointed downwards? All three answers are valid. Or did the trader CJ enter it incorrectly and did not follow the trading plan? It's a bit difficult because it's too complex, this one. So I apologize for that. I think I went a bit into too many details maybe, but I will already exclude E because that's just too complicated. Forget E. It's only A, B, C, or D. So it's up 200 pips. Is that a good thing? B, engulfing twins. Is that a good thing? And Tenkin pointed down for an up trade. Is that a good thing? That's basically it. Or are all three valid? Kalian, enter in a second candle. It would be better to exit half at red candle at fib 272 and trail the second half. Yeah, I agree. There's a typo there somehow. anyhow, it was not too relevant for the entire quiz question. I think I meant something else, but the exit and entry at the same spot, of course, doesn't really make much sense, but let's forget that part. We had an entry here at the 50, and the question, do we want to scale in another one basically at 0.2? It's difficult, actually, to make quiz questions because more difficult than I thought, because you kind of like have to give some info, and we're looking at one screenshot, but got 4 questions, 4 answers, so waiting for a few more, hopefully. Is the second entry a good scale-in? So point A, it's up 200 pips, engulfing twins, and the Tenkan is pointed to the downside, or all 3 are valid. Don't be scared or shy. Not going to get a diploma, unfortunately, nor any disadvantages of answering. Five answers. Come on, just 2 more. Are there 2 more there? Are there two brave souls willing to risk their fame without their fortune necessarily on the line? So I'll put a timer then, because it doesn't seem to be Vikantas will wait. Ah. Funny. All right, fair enough. I'll give 20 more seconds. What time frame? Daily. Vikantas is waiting for confirmation. That's a good one. Maria, it's a daily, so I'll give you a couple of seconds there still if you want to answer. The EMA, okay. I'm not sure which answer that is, actually. There's no EMA answer, sorry. So we have 1C, 3 times B, 1D. And the correct answer is, according to me, at least, the judge. Oh, Vikanta says D. So we got 3 B's, 2 D's, 1 C. Majority still says on B, but it's close. In my opinion, B, the B of Bernard or the B of Bravo. And why? Well, A, usually what I do is treat scale-ins as separate, although it makes sense to a certain degree. There is a logic there. I wouldn't necessarily, I can understand that traders think that way, but I like to treat scale-ins just as a separate kind of entity. So that's why I said it here, because with that reasoning, like that, I prefer to see them still as separate things. Now, of course, if we plan a trade beforehand, I do take sometimes an entry at the 50 and the 61.8. And if I make sure that my total risk is not exceeding the total risk that I plan on, having an entry at the 50 and a 61.8, there was nothing wrong with that. So, but usually if I scale in later on, it doesn't really, like I think it's my point is basically is that just being up a few pips doesn't. It's not good to let it lead to overconfidence necessarily in a trade. I think it's better to see them as separately. That's kind of my point. So maybe a bit disputable, that one. Engulfing twins, definitely, that's a good thing. That's a good supporting element. It's obviously a good factor there from a discretionary point of view. C is not good, and that's kind of the hint maybe that if you had doubts about A, that D is not the right answer, because C, Tenkin down, Tenkin is actually, and of course if you don't know the Tenkin then that's a pity, but the Tenkin is a momentum indicator in a way, or like a moving average. You want it to be pointed in the same direction as the trend, as the direction of where you're looking for. So if the Tenkin is down and you want to look at trade it up, then the Tenkin is not showing upside momentum there. So that would not be a confirmation. So that's why C is not good. So that's why B, that's the reasoning. So you may disagree, but that was at least the thoughts. I guess we have time for one more. Okay. So trader CJ again has a second strategy besides this Tenkin EMA strategy. Without going into all the details, the quick trading plan explanation shows that CJ is looking for candlestick rejection at the top and the bottom of the Bollinger Bands. CJ's plan is to trade reversals when price is reaching the extremes of the Bollinger Bands, but CJ will wait for candlestick confirmations before trading it. So CJ is looking for bearish candlestick patterns touching the top of the Bollinger Bands, or for bullish candlestick patterns at the bottom of the Bollinger Bands. To establish whether candlestick patterns have occurred, CJ only uses the candlestick pattern recognizer, and you'll see those candlestick names on those candlesticks. So for those that maybe were like, well, tell me again, here's the quick review. He or she is just using the Bollinger Bands for rejection, wants candlestick patterns at the top or bottom. That's all. How many signals do you see here in the orange box? How many qualify? Three, 4, 5, 6, 7, 8, 9, 10, 11, 12. So basically you see anywhere from 3 to 12. So I'll leave it on this slide so that you can count. In total, how many candlesticks are in that zone? I now count that for you. 1, 2. Everywhere there's a green dot, it's a candlestick with a candlestick pattern. 4, 5, 6, 7, 8, 9, 10, 11, 12. So you guessed that the maximum is 12. That's why that's the highest answer possible. Minimum for sure is 3. Every candle with a green dot is a potential answer. So once again, the trader is looking for rejections at the Bollinger Band. So bearish candlestick patterns at the top, touching the top, bullish candlestick patterns touching the bottom. Got 3 answers, all various answers, so I'll wait for a few more. Maybe we can swing it into one direction to have a more of a clear winner, maybe, if there is any. Who knows? I would, Wendy, was just as you look at this slide for a moment, just something of my own opinion on what Tarantula was telling you regarding jumping on the train. I think that is definitely something that is a very, 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 very good point. I mean, I liked all the points, in fact, but this one in particular I wanted to emphasize because I think that it's such a strong emotion to see indeed price moving into a certain direction, especially if you've analyzed it or if you and anticipated that but are not in, or if your strategy says that you should be in but you missed the boat indeed. Such a strong emotions, at least, or maybe this is my bias, but at least that's what I have felt so strongly in the past. And I can tell you it's really a relief to once you get rid of that, because it's almost like you feel constrained by chains with these emotions if you have that during trading, and it's really a relief to get rid of that. Let's see, Outrius, by the way, too interesting enough, was not part of the answer somehow. I asked, so I'll give you help there. It's actually anywhere from 3, including 3, up to 12. So 1 or 2 are not actually, were not part of the answers there. So I'll give you one more one more attempt. Let's see, we got 2, 4, 7 answers now, 8 answers, but Audrius can answer again. Okay, good. So with that said, I guess we can stop it for the moment. I'll give, let's see, half a minute or so. Half a minute. Does anyone need more time by any chance? Probably not, but I hope it's visible. I can imagine it's pretty difficult to see, maybe see it, but alrighty. So I'll sum up the answers here. We have 4 times 4. We have a 6. We have a 7. We have 11 and a 3. 3, 7, 11. 3, 7, 3, 6, 7, 11. 4 times 4. In my opinion, the correct answer is 4, indeed. So here too, majority got the right answer. So the group answers were right 3 times in a row. Great job, everyone. Applause. The quiz was a success. We have seen great results. For those that maybe had their individual results incorrectly, don't worry. It's just a quiz. But the reason why I said 4 was because if we look at them one by one, this first 2 green dots didn't touch the Bollinger Band. The ones that did touch the Bollinger Band have blue dots. These candlesticks, these 5, touched the Bollinger Band. Now you might wonder, how about this one? The red one. Well, it was very close, but actually the low missed it. So this is a bit maybe not so handy question, but it did miss it, that red dot. So if anyone would have said 5, I could have imagined because of that one. But actually it didn't really count, sorry, because the engulfing was bearish and it touched the bottom. We want bearish to touch the top, so no, that wouldn't count anyhow. Otherwise, all these candlestick patterns were not touching the extremes of the Bollinger Band. Only those 5. But out of those 5, the one with the orange dot is engulfing, bullish engulfing at the top. So it doesn't count, which leaves us 4 bearish price action at the top of engulfing. 4 bearish at the top of bullish band, sorry. So the orange candle is a bullish candle at the top, which is the wrong combination. We're looking for bearish at the top or bullish at the bottom. So we have 4 bearish at the top, 0 bullish at the bottom. All the others didn't touch the Bollinger Band. 5 did, 1 was close, 5 did, 4 qualify. So that's why the number 4 was the right answer. So, well, thank you all for your participation despite the silly quiz. So I hope you still found it a bit funny. But more importantly, though, was Nenet's information on making the right choices. That is the real most valuable info. But this is something different than usual, I thought. So we'll be back next week. I had more questions, but we'll not be able to go through that. Next week with Tarantula on Monday, as usual, 6 p.m. and Wednesday, by the way, and then our webinar here together Thursday as always, and live trading labs on Tuesday, Thursday, and strategy on Wednesday in the morning. So I hope to see you then. Wish you all a great weekend or great trading tomorrow, and talk to you soon. Cheers.
Talk to you soon. Cheers. Bye for now.